Okay, hello everyone. On behalf of Tony Delapal, our 2024 chair, the Councils of Real Estate welcomes you to this presentation of the Economic Balancing Act, featuring members of our esteemed Economic Advisory Council. If you're joining us for the first time today, I think you will find the discussion not only informative, but spirited and stimulating as well. I'm John Henschel. I'm CRE. I'm the first vice chair of the Councilors of Real Estate and president of Henschel Real Estate Services in Abingdon, Maryland. Councilors of Real Estate is a distinguished international group of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, and credentialed problem solvers, the councilors reside in 22 countries and practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. I'd like to take a moment to recognize our 2024 sponsors, Busak Real Estate, Capright, Equus Capital Partners, J.P. Wigand and Sons, WPJ McCarthy and Company, and Barbara and Steve Leader, CRE Emeritus. Thank you all for your support. Before we begin, I'd like to offer you a free digital subscription to the counselor's peer-reviewed professional journal, Real Estate Issues. It's been named one of the top 10 essential real estate publications in the U.S. and is available to you by visiting cre.org/REI to subscribe. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcome, and we'll answer as many questions as possible as time affords. I'd like to introduce you to today's moderator, Joshua Harris, PhD, CRE, Executive Director of Fordham Real Estate Institute in New York. Dr. Harris also serves as Managing Partner with the Lakemont Group, a boutique real estate and economic consultancy based in Orlando. And he has held prior academic appointments at New York University, St. John's University, and the University of Central Florida. Prior to joining Fordham, he was Vice President of Investment Strategy for Skanska USA Commercial Development. Dr. Harris was invited to membership in the Councilors of Real Estate in 2015. Welcome, Josh, and I look forward to a very spirited discussion today.
Yeah, well, it's great to be here. Obviously, these conversations have kind of taken on a lot of fame. Counselors, I know we get a lot of good attendees from across the real estate industry. And I always like to say, if the economists are interesting, that's probably a really bad sign for the economy. So hopefully this will be a very boring conversation, although I don't have a lot of confidence on that. So we made a decision in the prepping of this panel about that. Essentially, we were just going to kind of go with the higher for longer assumption. Now, I know we've had some good, the most recent prints on CPI and PPI and some other inflation readings. Even this morning's retail sales have been more favorable per se, which is always a good thing. So we will allow everyone to move around with the assumption. But if we really are in higher for longer world, right, talking about interest rates, which obviously have a lot of direct impact, what type of impacts or adjustments do we need or have yet to sort of been realized in the commercial real estate markets? And I'll start with, I'm going to do just alphabetical order and start with Michael Atherton.
Well, thanks, Josh. Thanks for having me on today. This is a great group. There's a lot of enthusiasm for lower interest rates broadly across the investment world, real estate in particular. But I keep doing this thought experiment with people that I work with and say, okay, like, look, the Fed, let's just say, sake argument, they cut the next 10 meetings in a row. They get the Fed funds rate down to 3%. The yield curve should still be upward sloping. So I think your assumption that interest rates are going to be higher for longer is a good place to start. I would say, and I'd be real interested to hear what the rest of the people on the panel today have to say. I would say that most assets haven't repriced to reflect any of this. Debt costs are still well above where stabilized yields are. NCREIF is being collectively valued at a yield way lower than any of this stuff. And when you talk to people, particularly when you maybe talk to acquisition people about this, they come back and say, yeah, but everything's trading below replacement cost. Well, I don't know, maybe replacement cost is the thing that's wrong then. So I don't know. I see Jim throwing up his hands there. Jim, what do you think?
Replacement costs is such a BS measure because every deal brought to every one of our clients in their investment committee, every acquisition person always says it's below replacement cost. But nobody has any good data on sort of measuring replacement costs for every asset. So it's always kind of a fuzzy thing. But just because you could buy it cheaper than you could build it, is it still too expensive? You know, that so I was laughing about the replacement cost issue, but your point on you know the rates, I really think one of the challenges that when we talk about this notion of like higher for longer, part of it is just getting back to a sense of normality. What is high is the rates relative to where we were in this ultra low rate environment since 2009. And, you know, we have, you know, except for a couple of us on the call, you know, some of us have been in the industry for, you know, multiple decades, but there's senior people in our industry now who have only worked in this kind of low free money environment since the financial crisis.
I keep reminding everybody that we should everybody in this call should want the Treasury to have a positive real yield. The whole world works better. Capital gets allocated much more efficiently when treasuries have a positive real yield.
Exactly.
And everything flows from that.
But when we go to this higher for longer, it's like it's not necessarily like 1980s high. It's just, you know, getting back to this kind of normal world high.
And, you know, Kim, who obviously comes a bit from, you know, obviously the agency world, tell me how you view this, and to the extent you guys have internal forecasts or your own, I'd love to know what the kind of the current perspective is, and I'm sure so with the crowd.
Yeah, sure. You know, especially for multifamily. I mean, it's very similar in that I think exactly what Jim is saying. There's actually not a lot of trades going on, not a lot of property sales going on. What does sell, I think, is, you know, it's either been sort of discounted or they're just taking, you know, whatever they're willing to take. But I think that's what's this lack of price discovery, at least on the sales side, I think is what's really just keeping things sort of in a, you know, in a stasis, right? So what's that led to is that a big decrease in originations across the board, not just for the agencies, but, you know, for all the market participants, probably not a surprise to anybody on this call. So, you know, last year it looks like originations were low, and I think this is going to be another year where we're not going to see a lot of new originations. But think about it too, you know, if you've got a multifamily property that is performing, and most of them are performing, and you've got a lender that is willing to give you an extension because, you know, you've got a pretty low interest rate, maybe they give you an extension so you can get an extension. But you can also there's a lot of dry powder out there coming from not only debt funds, but equity funds. So maybe you get a capital infusion as well. It kind of goes back to at the beginning, we were like, things aren't priced right. And, you know, I know they use the replacement cost thing. I've heard that too. But I think it's more of people are waiting, you know, they're investing now because they figure in 2 years, when we don't have a lot of new supply coming online and the current supply has sort of been absorbed, because we have the demographics and because, you know, single family houses are still fairly expensive in a lot of parts of the country, not a lot of it out there necessarily where people want to be. I think that a lot of these investors are just saying, hey, I'm going to get in now because in 2 years, this is all going to pop.
And so Will, and obviously within the, you know, the life co world and everything, how are you guys? I mean, I think in a weird way, right? Aren't higher interest rates somewhat or normalized better on some parts of the portfolio? And how does that affect the real estate side?
Yeah, so we invest on behalf of insurance companies. You know, over half our book is there, and whatever's happening on the liability side is benefiting from the higher interest rate environment. So insurance companies usually do well in higher rate environments. You know, going back to your question on where rates are going, I think, you know, for those of you who are on that are counselors and for anyone that's trying to give guidance on this problem, I think it's worth really pushing back on giving the answer as a point estimate as opposed to a probability or a distribution. To really have a meaningful view, a point estimate on where interest rates will be in a year, you probably need to know who's going to be controlling Congress. The Senate probably need to know the private thought of the Saudi royal family and what they're going to do with oil. You probably need to know where immigration is going. So these are things that I don't think there's really anyone that's qualified to say exactly where rates will be in a year. What we can do is look at distributions and look at when underwriting real estate, for instance, how that real estate may perform under those different distributions. And I think we as an industry in real estate need to move beyond stressing the terminal cap rate by 25 or 50 basis points up and down.
Well, that's it. On that, you ended at a perfect place to kind of tee up my sort of the question that I think all of you kind of dodged. Maybe Michael maybe tried answering a little bit, but that is okay. Let's just assume 10-year treasuries are 4.5, 4.25, bounce around that zone like they've been doing. Okay, cap rate spreads. I mean, have all the portfolios? Have we marked to market? Have we adjusted cap rates and valuations on the books or the portfolios of all of our various clients and portfolios as they're running? And Jim, why don't you go first? You might have an interesting seat on this one.
Yeah, it's funny though. I was touching my ear because Will, you start talking about politics, and all of a sudden, your sound broke out. So it's maybe that's a funny technique for to use in a webinar. In any case, the deal environment. If we think about that, it's still just tied up in the fact that everybody is on pins and needles waiting. Kim was talking about people weren't thinking about 2 years from now, what's going to happen with limited supply. And so there's some gaming around that, waiting to see how performance ends up and waiting to see who has to sell and who can hold on. It's a different kind of environment than previous cycles because, and I think part of it just gets into the long history of experience that people have because there's people active in the market today who were active after the financial crisis and knew that there were vast fortunes made in the repricing that followed. And so nobody wants to kind of give up the ghost too early. And yet potential buyers are there wanting to underwrite every worst case scenario. Just cover themselves as well.
So Jim, does that mean the bid-ask spread is still pretty wide? Is that what your internal data has shown?
It's still wide, improving for some sectors. I think it's just going to vary by sector as well. The office sector, particularly CBD offices, and places like where I am here in New York, is where the challenge is felt most intently. Not every office, if you're in Miami, there's different performance metrics there, and that's coming from a guy who's in New York.
I'm actually currently in New York today, broadcasting live, so I know that feeling. Michael, what do you? I mean, and obviously, I'm not asking you necessarily about anything you specifically work on, but just your general thoughts about for the various institutional asset managers and other funds that certainly have mark-to-market requirements or annual valuation procedures. Do you think we are whatever we did at the end of 2023, which I know everyone was kind of breath holding in a way about lack of transactions? Then are we? Where are we in this? Are we gonna? Are we at that mark-to-market bottom, or do you think we've got some year-end presents to be delivered by our appraisers and our valuation groups?
Well, if yields are going to stay more or less, treasury yields, other yields, corporate bond yields are going to stay more or less where they are, and we still think investors are going to demand some sort of premium yield over that to be in real estate, then yeah, we still got a ways to go. I mean, it might be, I don't know, pick a number, it could be 10%, 15% more valuation adjustment if we're going to fully go there. In the period following the GFC, yields were kind of messed up as well. But they eventually adjusted back. But that was a period where it was very different, as Jim was saying, it was very different. There, the Fed was aggressively cutting. They were aggressively injecting liquidity. The recession had already happened. So the recession was behind you. you could credibly underwrite recovery from recession. You could credibly underwrite significant increase in liquidity coming. And so holding on really made a lot of sense. Trying to hold on made a lot of sense. You'd already had all your operational disruption. All the defaults early on in the GFC period were all operational defaults, tenants not being able to pay their rent, homeowners not being able to pay their mortgage. And then eventually you came into the maturity defaults. Today, it's really just the opposite. I mean, there are operational problems, obviously, in office buildings, but the defaults you're having are maturity defaults. They're not
Right.
cash flow problems yet. They could be. I mean, if we have a recession or something, it could become that. So it's everything's sort of in a reverse order this time, and everybody sort of naturally wants to fight the last war, right? So that policymakers try to fight the last war, investors try to. Like Jim said, people are looking at that playbook and saying, how do I repeat that playbook? But it might not be the right playbook.
Michael, it's an interesting point. I've actually been giving a lot of thought to this, certainly with regards to sort of maybe more consumers, even the housing market. We did have, I mean, '08, which I always wonder if '08 was the fear of '08 as it was happening kind of right in the worst part, when you actually measured the depths sort of through 2009 or middle 2010, was it really as bad? Sort of the screaming headlines made you think it was going to be. And one of the things about the amount of stimulus that sort of effectively took hold for the economy because of interest rates going, but I mean, the 10-year was around 5, right, in 2006, and parts of 7, right, and went down to like nothing, right? So clearly we're in a reverse of, like you said, we're in reverse of this. And Will, before I'm teeing up this question for Kim and her role, but I want Will first for you to kind of following on how I asked Michael just about the, on the commercial, the traditional commercial asset space in terms of mark to market vis-a-vis, call it a 4.5, 4.25 10-year treasury base.
Yeah, so one, data point that I guess I could offer to the conversation is I've been tracking, especially over the last couple years, the difference in transaction prices versus appraised prices in the NCREIF universe. And that's that the NCREIF assets usually are appraised once per quarter. The peak disconnect occurred in the third quarter of last year. And in the office sector, for instance, there were about 20 trades, and the average trade was about 25% off where the appraisal was, the current appraisal. That has narrowed very quickly in Q4, Q1, and I suspect Q2, it will be even narrower. So outside of the office sector, if we look at the other property types, I think Q2 could end up being the trough for real estate price indices this cycle. The office sector seems like it still has a way to go, a ways to go. That's just, again, comparing spot market numbers with where appraisals are. As it relates to, Michael's comment, I was with him in thinking that cap rates, discount rates were not supported based on where treasuries are and corporate bond yields are. Up until maybe a month ago, this decrease in treasury rates, and then even more importantly, the decline in bond spreads has, I think, brought cap rates back to more normal long-term levels, or that relationship compared to treasuries is closer to being stabilized.
Right. That 200 basis point spread puts you at the sort of mid 6s, basically.
It's becoming, maybe cap rates are a little tight, but it's becoming closer to a rounding error than a clear disconnect from the historical norms.
Yeah, I just want to follow up on something that Will said. This disconnect between where the appraisals have been and where the transaction prices. This is really a North American phenomenon. It's not happening to the same degree in other parts of the world. And this is the same. This cycle is less. That's one thing where there's a structural thing that's the same this time as the financial crisis. You look at central London in the financial crisis versus Manhattan, prices and cap rates moved a full year before in central London, before New York, and very similar economic drivers of two big global financial hubs. The RICS valuation standards allowed the appraisers more leeway to bring in other information from other asset classes and performance. Plus, open-end funds had a much more immediate need to pay back on redemption queues. There's no gates possible. So there's a little bit more of an incentive to get to that number faster to prevent fund outflows. And so it's a different structure in the United States that is making, in some sense, I feel bad for the appraisers. I think that they're just not given enough tools, enough leeway to reflect the reality that is in the transaction market.
Thank you, Jim. That's a very good point. I remember last year there was a lot of people were complaining or commenting on the difference between the European action and those companies that had funds or investors from both sort of were dealing with this explain it to me problem. But with that, Kim, I want to ask you kind of a final question on the first topic, and then kind of open up what I've kind of listed as our second topic, which is sort of the consumer sector and the inflation sector. So obviously, apartments, multifamily, have always enjoyed a much lower, lower cap rates relative to pretty much all other commercial asset classes, at least certainly in the last 10, 20 years. Which also means mathematically they're more subject to valuation swing from an underlying move in the treasury just by pure math. So first question is just how that adjustment factor you think is specifically affecting multifamily, which might have more not as much cushion as spread is, say, I mean, God knows office whether that's operational, but certainly kind of why you don't see the same thing for retail or industrial. So that's one question. And leading into that, if you want to start opining on where you see the health of the consumer, both as a renter, obviously as a shopper, and all the things, because that is, increasingly, this has been can the consumer maintain what does their financial picture look like with also, because of higher inflation, there's also kind of higher prices, et cetera. So Kim, please take it away.
Yeah, no, thanks. So, so to the first question about the spread between cap rates and treasuries for multifamily, yeah, it's a little tight. I would say though we're not overly concerned about that, and I'm going to explain why. Because when we have a chart that we show when we're out presenting, and it goes back in time, and you can see that the last time that spreads were this tight was sort of in the run up to the Great Recession, right? And so I get a question all the time, like, well, that spread was so tight, and then then we had the Great Recession. We're kind of in a similar vein now. Why are you not so worried? And it's really this answer is that back then in the 2008, leading to 2009, a lot of those multifamily transactions were actually driven by condo conversions. There was a big demand for sort of owned housing. It's to us, condos are still single family because they're individually owned. So there was a big demand. And so a lot of the properties were being sold for condo conversions, pushing that cap rate down because the developer was going to flip those units into condo and be out, right? Today, we have actual demand. It is demand from renters, from these renters that are out there, not condo conversions. I mean, there's hardly any, and there's very little new condo development. So to me, the difference now is we have actual demand from actual renters. And so that is less of a concern for me, because we know that they're also staying longer as renters lately. So before, the first time home buyer was, and I don't quote me on this number exactly, but it was something like, I'll say 32 years old. And now it's something like 36, 37 years old. So they're staying renters a little longer. And with single family housing prices still elevated in most parts of the country, and sort of a lack of single family housing in a lot of places, we're expecting that those renters are going to stay renting even longer. So that spread can kind of stay a little more tight than it has in the past. Just quickly on the consumer, yes, we do think that most consumers are getting the pinch, right? They're feeling it, especially in the class B and C units, which are the more affordable units. So those households are definitely feeling the pinch more. How much more of a rent bump are you really going to get out of these people? I don't think there's going to be much there because they are so stressed with other things.
Yeah. And Kim, stay with you and follow up. I think this consumer question is something that is sort of I've been paying a lot of attention to. There's obviously a lot of political dimensions on this one clearly with the with the election might be a driving force or could be the driving force in the election depending on who you listen to. Um, and I've made this statement, and you can disagree or not, but I look at when I look at either multifamily or rents, and the same thing is for single family housing prices. Like there's certainly no oversupply. I don't know anyone, even in markets where you might have some temporary oversupply by too many units all delivered the same month. Any long term measure takes that away, but there might be an overpricing, and that the rents, even if I'm working for the pro forma, right? And I spent time working for a developer, and what you did to pro forma in order to make it work. And this gets back to that replacement cost issue, right? Well, replacement costs are high because, construction prices shot up, right? So, I guess the question is, is there some spillover risk, either broadly economically or certainly in the multifamily, market, to just, if we do have more of a resetting of fundamentals, which could mean either slower. Look, even if you have flat rent growth, you probably have rising op costs, right? So your net operating income is getting probably pinched. But also even housing prices, which again, with insurance and other op costs and other tax, and who remembers wealth effects, right? And I think one of the fears that if the consumers start to not be so thrilled about the value of their home or even what they have to spend because they're afraid of the next rent increase. They don't want to buy, take the Disney vacation or buy the new car. Could we have a spillover into the macro economy from this sort of consumer readjustment process?
Well, I think if you're thinking about single family homeowners that, are saying, hey, my equity's way up. I want to get out, I want to start putting my house for sale. And others that are just feeling like, I know I've got a 3% interest rate, but I need to move for whatever reason. I got a job, it's a lifestyle change, whatever it is. We are anticipating that people are going to start, that logjam is going to break, and that people are going to start putting their houses up for sale. As we see that happen, we are expecting that increase in single family housing prices to actually start to come back down, right? Because it's been too high for too long and it's not sustainable. And we do have this lock-in effect, but do we really believe that people are going to stay locked in their homes for the next 25 years? Maybe some people, but most people, a lot of people, they tend to move. So we do think, and so if you look into our forecast, and that's what I'm speaking to, our forecast up on our website, we show that housing price increase is expected to actually tick down and sort of stay just flat, over I would say, I think it's starting in 2026, really just be at around zero, stay flat for a couple of years. So that, you're absolutely right. So now at that point, maybe I could buy a house, but am I really going to have the income to be able to afford the house, even if prices don't move, even if they stay stable, because they've come up so high? So we still believe that a lot of people will continue to rent. Now, back to your question about the rental prices, right? So how much can we keep increasing rents? Well, if you look into our forecast, we're not expecting the rent. We see a little bit of a bump for 2026 because of that lack of supply. But after that, it goes back to the norm, which runs around inflation, if you think about it. If we go back in time, that's right, exactly.
Maybe not if you're necessarily a developer or like a merchant builder and you want to, you're trying to nail out inside of like an 18-month, less than 18 months, but everybody else in the economy, yeah. Jim, what's your view on, this specifically the consumer sector, and is there transmission risk vis-a-vis sort of the tap out effect?
Yeah, the tap out effect is something that is, I've been worried about that for retail, because retail properties were the whipping boy for many commercial real estate investors in the last 15 years, with people heralding the death of malls and everyone's going to buy everything on the internet. And, there's still some truth to that in terms of still faster growth now post-pandemic for online sales, but there's still a lot that happens in the store. But income had been growing, and so property income for retail had been growing. But there comes a point when, you get stretched. But then add that housing cost component on top of it. I tend to think, though, that at some point, if housing costs become too much, households economize. I don't live in Brooklyn. I'll move further out. I'll take on a roommate. And so now it does effectively reduce housing demand because you'll have fewer households or
On a regional basis.
and a bit of a change in households. Although some of that had already played out. That was one of the rationales for people leaving for Florida, from New York. This is a topic Josh and I go back and forth on all the time. But that's been spent out because like if you go to a place like St. Petersburg, people there in Florida, not the other one, people complain about all these New Yorkers who have moved in and driven up the rents, but at the same time they've curtailed construction. So you have wealthy people moving in, driving up rents, and you limit supply. Guess what happens? The same kind of problems as other parts of the country. So maybe that element doesn't happen as easily now. It's not cheaper necessarily to move to some other cities, and so that's a safety valve that's a little bit broken too because of the limits, because of all the NIMBYs limiting construction activity.
Jim, it's a good point. I will say this is somewhat of a personal observation, more about Florida, but I can contrast it to New York. I'm spending time between New York and Florida, so I'm like who isn't these days is kind of a joke, but and it's I will say that the Florida economy, I mean, obviously benefit. I mean, it was pretty hot for a while. COVID only helped per se, be it differential policy effects of like the lockdowns, be it just the fact that taxation and work from home, you name it. But I will say that Floridians don't have the same income base, and I'm starting to, there's a lot of. I mean, I don't look at necessarily, definitely not like downtown St. Pete or Central Core Orlando or any part of Miami or anything that practically touches the tri-counties, but go look at housing metrics in Cape Coral. Go look at some of the things even out in Kissimmee or Polk County, some of these that are, I remember because I was in Florida through the way they were the same cities with the exception of condos, because no one did condos in this cycle, kind of like Kim pointed out. It's kind of the same places that were kind of the canary in the coal mine market, or what would prove to be the canary coal mine markets of the housing market back in like 07, the ones that, the places that kind of stopped, they're kind of having the same, not the same issues. They're not trained because you don't have the defaults. I mean, that's the one, that shoe hasn't dropped, and I'm not sure if it will, but I have to say and now it's, of course, I get Austin, Texas on these lists, which is just kind of, totally different, right? I mean, so to that, I'm going to turn over to Michael and then to Will. How are you guys modeling or just factoring sort of overall consumer sector in your kind of internals, or just what your own personal beliefs are on whether they're, and the specific question I'm trying to drill in on here is there a spillover risk in the sense that the consumer, be consumer weakness becomes the place that we start to sort of see problems that might become more epistemic?
Well, it could. I mean, I think that when you start thinking about the consumer, I think you got to first stratify it. I mean, there's a lot of ways to stratify our consumers, right? One real easy way is by age groups. The youngest boomer just turned 60 this year, right? And there's what, 65, 70 million of them, something like that. They have almost all the wealth in the country. They're at least the ones that have the wealth. And let's be real honest here. The boomers are not uniform in their affluence, right? There's a lot of really poor boomers who are really going to be up against it in retirement, already are. But the boomers who do have wealth are generating a lot of income all of a sudden off of these 5% money markets. They're kind of loving life in that regard. Millennials, I mean, I have a child that's in the millennial group. They're emotionally very strained. There's just no way to get around. I mean, Kim kind of referred to some of the things that they're doing, buying houses later, starting families later. But when you think about this group, I mean, their earliest memories are really around 9/11, and then they aged into the labor force during the financial crisis, and then COVID happened. I mean, it's a group that's been just battered, by one thing after another. And the Gen Z group is really quite different than the millennials. I have other kids who are Gen Zers, and they're very different than their older sibling. And all of them are feeling these stresses in very, very different ways. There's really no way we're going to get prices to move back. When I say prices on like everyday things. Like I joke around with people here, if Biden could get bacon down to $5 a pound, he'd win in a landslide, right? I mean, I think bacon is like the best predictor of, you know, how happy people are, because everybody likes bacon, you know. So it's just we almost have like 3 different
I'm going to
countries.
start the bacon index. I like that. That's great. The
Say, like,
bacon index.
Michael, you're going to be known for that. We're going to ask you that each time.
Okay. But, you know, we are really a country made up of really large groups facing very, very different stresses based on where they are in their life cycle. And a lot of the boomers are going to be able to keep spending. They're going to have a place in Florida. They'll probably keep their place somewhere else, because let's face it, you can't really live in Florida in June, July, and August anymore. At least not in most of the state. Maybe if you're on the water, you can. So Florida stays pretty popular. In other places, the Carolinas are really hot now. No pun intended. Phoenix is pretty hot. And those places probably stay that way for quite a while, because we're going to have 50, 60 million people retiring, you know, or already retired really quickly, like in a blink of an eye. So the pressures on those housing markets stays very, very strong. But you're absolutely right, Josh. The last time, right before the financial crisis happened, the affordability measures in these places that historically have been affordable, places like Tampa and Orlando, they got totally upside down. And you can't fix that very easily. Either move home prices or housing costs a lot, or you move incomes a lot. And, you know, I know there's good things going on in Miami in the office market with private equity guys and stuff like that, but the whole state isn't benefiting from a one-time change in the structure of the wages. So it's got to fix itself eventually, one way or the other.
I will say it is far easier to adjust housing prices than it is to just raise everyone's income. That is that is the truth. So, Will, what is your thoughts and your perspective on the consumer?
One data series that I'm at least watching pretty closely has been credit card delinquencies, and those are leading indicators of losses. They are at a 10-year high, although if you expand that chart out to the last 20 or 30 or 40 years, it doesn't look too severe. I think it actually is somewhat concerning, because 20 years ago, 30 years ago, many of those delinquencies were people forgetting to mail in a check, and it's all automated now. So a 3% delinquency rate today is worse than a 3 or 4% delinquency rate 20 years ago. I am not an expert in this, but I'm just worried that the rating agencies and the whole industry there is appropriately understanding what this, you know, pretty sharp rise in delinquency has meant over time. If we are, you know, and this is not my base case view, but if the economy or the consumer is entering a downturn, I think this will be an indicator that we'll look back at and think, oh yeah, we probably should have paid more attention to that. But you know, just one other quick point, immigration has really been a significant story over the last 3 years for real estate. The household survey and the payroll survey that the Bureau of Labor Statistics releases 1 month or every month are completely disconnected from each other now. And I don't think that's ever happened before. It's happening because the Census Bureau has not been updating their population projections. So there's a denominator problem with both the unemployment rate and the participation rate. That suggests that labor markets are probably a little stronger than the readings actually are, or at least than the unemployment rate is. So until that changes, my concern level is low, notwithstanding that, you know, that the credit card delinquencies that I've been monitoring.
I will say the one that similar, and I follow the credit card delinquencies as well. The one that scares me more, because I think it's more indicative of severe distress, is the auto delinquencies and auto repossessions, which have been up quite a bit. Some, I don't know if they're where they are in term. I mean, I doubt they're as high as they were back in 08. But they're a near term high, and going up. Which, when someone's willing to, or not willing, or has to let their car go, because that usually means your job is gone too, or something is, you know, intertwined there. That one kind of shocks me a little bit. But it is an interesting question that I think about. I mean, immigration has all kinds of impacts on this, and whether or not whether the job market is as strong. And actually, I guess I don't, you know, the job markets, we talk about these differential data series, if anyone else wants to jump in on that. But does anybody else? I mean, look, by all measures, you know, the most, like I said, this is the economists be boring, right? The job market has been the most uninteresting thing to talk about for a long time. I mean, unemployment's just been, maybe it hits 4 back to 3.9, which, is great by all historical and any current measures. We get still prints of like 200,000 to 300, somewhere in that 200,000 range, which nobody, right. Is everyone in agreement that just, my God, this is just an awesome job market as ever? Or does anybody have a contrarian take or explanation for this?
There's been a lot written about the birth-death model on job and in the job creation, the monthly numbers. It sounds like there's going to be a pretty negative revision next March, maybe 1 million or more in total employment to the
Like
negative.
they're going to reduce the number of total jobs that are, because they've not captured the people who have died. Is that, I hate to say it so bluntly, but that's what that means?
Well, it's birth deaths of businesses. How many businesses got
Oh.
started and how many businesses went out each month. And I mean, I think my daughter's a labor economist at Miami University in Ohio, and talk about this stuff a lot. And it seems like we're going to be studying it for years, and not there's a lot going on in our labor market that we don't really understand. We haven't really
Like,
modernized the way we measure and survey and things like
where's your
that.
Uber driver and all that?
Yeah, like I mean, like you mentioned cars, people giving up their car. Like if you don't have to go to the office, does it really matter if you give up your car as much? I mean, I don't know. And the average car in the United States is over 10 years old now. So
Yeah.
you're giving up a sort of wasted asset, maybe not.
I will make an observation. This is definitely sort of returning to Florida or spending a lot of time starting in Orlando. I mean, look, across the board, tourism, hospitality. Florida, we're just launching a hospitality degree because we see so much extra demand. This, part of a kind of sprouting out of a real estate institute. We see this is a huge growth area. But I mean, you look at tourism and live events. I mean, the Taylor Swift economy. You can name your thing, and this is. I mean, tons of spending now. But I will say, like in like Disney World, I don't even want to even look at the place. It's so crowded and expensive, but it's also supply constrained, right? I mean, they do not have, it's fundamentally nearly the same capacity as it's been for like almost, I think, 20 years. I think when they last opened parks. I mean, there's a little bit of, airlines are very supply constrained because, we can't get one of our two major manufacturers to make good airplanes as fast as they used to. So I do wonder when we look at all these metrics if we're maybe over believing something, but I do, Jim. Do you have? I mean, do you have any? Are you as completely rosy on the job market as everything? I mean, I pull a data series that necessarily maybe I've seen the jolts, like the openings seem like they're starting to fall, but it
Yeah.
doesn't. They were, forever. So I don't know what that means, right?
Honestly, the stuff I've been following on the economy in the last few years hasn't been the real side of the economy as much. It's not the production, jobs, how much you can drop on your foot part of the economy. I've been more focused on the capital side, rates of return,
Yeah.
relative pricing. Let's let smart folks like Michael's daughter tell us what to think about on the labor markets. And she's a labor market economist now in Miami, but someday we'll rope her into the real estate world.
By the way, some of the great one of the great real estate economists, Jeffrey Turnbull, I got to work with at University of Central Florida. He started as a labor economist, and he always kept those metrics and models, and I think it actually helped him understand housing markets, everything far better, because it is the leading indicator. We joke about it, but for everybody, and certainly all the counselors out there, look, labor jobs are pretty much, with maybe the exception of like data centers or something, it pretty much is the leading indicator or leading driver of physical goods, physical material. Tim, I guess the clearly jobs and apartment demand have had probably one of the strongest correlations of any direct measures, right? So I would assume that if there were a problem, certain in any markets, you'd see it in the apartment demand data probably pretty quickly. I'm assuming from your point, all quiet on that front. Any interesting indications or can you satisfy this whole what was it, BEA versus census or BLS versus census panel, or
we are somewhere in between, right? We're somewhere in the middle when we've come up with our numbers. But you're absolutely right. This is what I tell people all the time, that for multifamily especially, it's all about job growth. If we don't have job growth, they don't form a household. If they don't form a household, they don't rent an apartment. It's pretty much, that's the three legs of the stool, of the housing stool.
Yeah.
And because mostly most renters of multifamily tend to be younger. They tend to be in that 20 to 34-year-old range. A lot of them are starting out in the world, starting at forming, getting that first job and forming that household. So we are very focused on job growth, less so on unemployment. If I can just, I'll just take a second for folks who, because sometimes I get this question. On the single family side, we're very, people are more focused on unemployment, because if one person loses their job, they're maybe not able to make their mortgage payment. But in multifamily, if one tenant loses their job, there's still the other tenants in the building that can afford to make the payments. So that's why for us, it's, it's sort of that yin yang of, we focus in multifamily more on that job growth and what that looks like. So you're absolutely right. A lot of it's going to be dependent on people. Did we get all those immigrants? Did we get these people? What kind of jobs did they get? So when we look at it on a metro by metro level, we're focused on what is the job growth categories. Where are they? So like, for example, in Miami, construction has always been a big part of that economy. So we do know, like, okay, we know there's a lot of construction jobs can be a little volatile because they tend to last 2-3 years on average. So, but if that's something that continues to build, you factor that in that part of the market. So it really does depend market by market rather than at a national level, right? Because nationally, everything starts to turn to, you mix all the colors together, you get gray, right? So we're focused on that employment at the metro level, because that's what's really driving it. And not at a, just very quickly, just not at a sub-market level, that's demand, but job growth is at that sort of metro level, because then it fans out throughout the larger part of the metro.
That's a very good point. I will, this just made me think of something that I start to wonder if this poses sort of more of a boundary to growth more than it is a risk to labor. But with so many people who are locked in at low interest rates who can't, there's got to be a negative economic connotation to this, but I don't think we've ever had a point where the more people couldn't essentially afford to buy the house they're living in. At any point probably in our history. I mean, look, how often do we have multiple people refining at 2 or 3% mortgages, right? So the flip side, we remember this after 2008 because people had negative equity, which is probably worse in a lot of ways, but it does that whole concept of immobility, right? And not for that, that's not a younger person. That's more of the middle, probably 35 to 65 kind of working age people. So I don't know if that would then make any wobble in jobs or the market more painful, because if you lose your job in one region and the better opportunities in another region, but now you're kind of stuck in one. I mean, it's something that I do think about, that the labor markets are. But of course, now there's this work remote thing, so maybe you just don't move, right? You just fly a little bit more and zoom in. I mean, it's just,
I think that is something that's possible, but I still don't think it's the majority, right? I think there's an opportunity to work remotely for many jobs, but most jobs they want people where they are. You've got to come into the office at least a few days a week. And I do think that eventually people are going to have to sell and move whether they like it or not. Sorry, Jim, go ahead.
Well, the other issue, so yeah, maybe the labor markets become flexible. And so on that real side, people can work remotely. Another proposal that's out there is to impact on the financial side. One of my colleagues here at MSCI put together a study looking at the potential to have portable mortgages disassociated from the underlying asset. And so the household then becomes responsible, that they can apply that to another asset in another location. What's that?
That would have been great 3 years ago.
Well, but it could still help today because, well, yeah, for me personally, it's been great, but it can help. That aspect of it might allow households to not suffer a kind of downside scenario where they have to make a choice between defending this asset and keeping a job, and that's another arrow of adjustment factor that might be introduced. It's going to take a lot of policy kind of stuff. That's a challenge. The potential for a lot of folks to maybe negotiate something to remote work, travel back and forth, that's individuals, and that can have a lot more immediate impact as opposed to a
Mhm.
big structural change from policy changes.
Well, I think that unemployment's also been pretty low, so people haven't really been forced to move, right? They still clearly have their jobs. If we get into a recession, and if unemployment starts to rise, I think that this all goes out the window, because if you can get a job, you're going to get a job.
Right.
Now, the issue will be, what can I buy a house for? But on the other hand, if we have more inventory available, that should start to stabilize prices.
So I think we have about, Bill, go ahead and make a point. I think I see
Oh, just the one parallel that I think is worth considering is the last time we had this lock-in effect was in the early 80s, when many households had lower interest rate mortgages. What happened then was home prices did not go down. They just stayed flat for about 5 years. On a real basis, they lost about 20% of their value. But as the subprime mortgage originators were saying in 2005, home values have never gone down. And they were right. At a national average level, they did not go down. I've looked at the data for migration patterns, and I was hoping or expected to see that migration slowed down because of that lock-in effect, but it seems like that wasn't the case, which probably just means the government wasn't tracking migration well enough. Yeah.
That could be demographic driven. That could be a demographic driven effect. Back to when the boomers kind of moving around. I've opened up the Q&A pane. So if anybody wants to submit a question, there's an interesting comment here. I'm going to kind of read it. I guess you all can follow along, but then I'm gonna make a response like everyone else. Says, I get a negative vibe from this discussion, yet the job market is strong, inflation is coming down, and the stock market is at record highs. Why the negative vibe? Well, first of all, economists are naturally negative. We're more interesting that way. If this is all happy talk, you probably would be like, you wouldn't even want to see what the comments would look like. But I will say, I want to give just sort of my own personal viewpoint on probably why there are some of these negative questions. Is that, by most measures, interest rates going from super low, whatever, definitely they're low, they're near zero, up to normal or massive moves. We have an inverted yield curve. We've had a lot of inflation. I think all economists is like, that's one of like the most evil words possible. But yet we're in this world. So I've used this analogy for people say it's like those Roadrunner cartoons where the coyote kind of runs off the cliff and they're just sort of standing there in the air and they're like, so the reason why there's, you're hearing negative vibes, and like in 2023 was the biggest prediction of a recession that never happened. Like if you look at the Philly anxious index, right? So the reason why that there's so much negative vibe is because there is actually a lot of cause for problems. It's just they haven't happened, and we're in such a unique zone. I don't know if anyone else wants to respond to that, but I thought that was a very interesting comment that was put in the question field.
Gee, I hope I wasn't coming across as negative, because I'm actually pretty positive and bullish on
I thought
multifamily.
this was the discussion I've had in a while, actually. No, but it is interesting that I think that there's a lot of the what's next questions is hard to answer. Do we think multifamily outlook will be? What do we think multifamily outlook will be for the next 18 months, considering inflation? Kim, I think you maybe have answered that, but I don't know if you want to add on or put that into a succinct sentence.
Yeah, sure. So we're actually expecting that on a national basis, that rent growth is actually only going to be maybe 1 to 1.5% this year, so well below inflation. And it was less than 1%.
Right?
Yeah, less than 1% last year. So we're actually not expecting rents to start to bump up a little bit until late next year, as I was saying, because we have a lot of new supply coming online. That's not to say there aren't markets where there's, some markets like Austin has been negative.
Yeah.
I'm sorry,
Kim,
say that again.
Kind of in a way, I was just saying, Kim, isn't that kind of a great prediction in terms of inflation getting back under control, which obviously rent and housing costs have been a big driver of? So
that is exactly why, and that's why you see inflation coming down, because shelter costs are a big component of the CPI.
Got it. Right. Let's see. The fact that young people aren't buying homes at age 37 a major problem for the economy in terms of family formation and expendable income. It seems to me that we have an entire generation that's falling way behind where they would normally be expected to be. This has major implications for terms of women having children later in life, which brings increased health costs with higher birth risk. Any reaction to that, or does that play into sort of anybody's economic viewpoint?
Wasn't that-
Jim?
Well, I'm going to go first
Go
because
ahead.
I'm one, a woman. Two, I was an old mom because I was a spinster for a long time. So I feel I can talk to this. All right. So what I'm going to answer you is that one, it's just a societal issue that'll, and not only are women getting married older, men. Let's start asking women to get married younger, guys, huh? Okay, we're all sitting around waiting, and you're all 40, and then maybe you pop the question. But all kidding aside, I think that it's just that we have pushed everything out. That's a societal issue. But as far as
Yeah.
multifamily and housing, it's very interesting, Gus, because in the US, we are so focused on owning a home, right? And it shows up in surveys too, right? It is the American dream. People want to own a home, young people want to own a home. It's not necessarily happening lately, but you know what they are doing? When I was talking about them all renting, yes, some of them are staying renting in their lovely Avalon Bay apartment, you know, with the beautiful pool and the gym and the dog park and all that. But actually, a lot of them move into single family rental. So they mimic that single family home ownership for a while by moving into single family rental. And I will also just throw out for a very, very long time, still true today, there are more people that rent 1 to 4 family units than rent 5 or more. The gap has been closing over the years, but there's still more people who rent 1 to 4 units. So it's still a very popular form of rental.
Jim, do you
As-
want to get up?
As the single guy here, why do I feel like Kim was attacking me? The
Get married, Jim.
Anyway, it is the case though in the housing boom that preceded the bust in 07 or so, birth rates soared, and part of it was just home ownership, the rise in home ownership, just more space. Hey, fill it with more kids. Space availability. When that is limited, when people realize they can't get a house with an extra bedroom or move into a bigger apartment. They start making decisions like that. And so, housing prices do impact life choice decisions.
I will say, as I've been teaching college kids since 2009. Kind of that was my way thing, was to go get a PhD and sort of win in this dual academic world. And so I've mentored and known a lot of students through that age range. And I will tell you that it is absolutely a huge stress point amongst the people in those age range. I mean, they want to have kids. They also want to have careers. I mean, it is a little bit of the, when you tell your children they can do everything, there is a stress of actually trying to do everything. So it is something that I don't know where it goes from a societal trend for thing to try to predict, because although I will say we are definitely pushing out the boundaries of sort of biology with various, the number of friends I've had who've had kids via IVF, and I'm in my early 40s. I mean, that's like, it's so normal. In fact, that's like the biggest new benefit that companies are offering, is paying for fertility care. So it probably has interesting economic implications, but it's probably to the economy net positive, because you have women are just a highly productive for the workforce and growing, and then so you have the higher dual income. I mean, the number of incomes that are probably over 500,000 or more because of dual income, similarly educated couples is probably off the chart. So that probably has a lot of long-term, big-time economic ramifications. That's my professorial view. Any final comments? I know Will, Michael, anybody, anything? I know we're right about on the buzzer for time, so I like to be respectful to everyone.
Just in the residential space today, we have the widest dispersion between strong performing markets and weak performing markets than has ever existed. So an apartment owner in Austin, Texas, or Nashville feels like the market is pretty distressed today, whereas an apartment owner in the gateway markets might actually be feeling pretty good about the sector.
Yeah, by the way, for the counselor that they're doing, in certainly the consulting, I mean, there's probably never been a better time to where ground level real estate market knowledge is actually needed, and all these great institutional assets, owners, which are represented by several of us here on the panel, there's probably more work and effort to actually understanding individual micro market dynamics than there's been in a while, and I think that's probably good. Michael, anything final? Otherwise, I think I'll close this out here.
No, I wouldn't want to hold us up. Thanks, Josh.
All right. Thank you. So it's been a wonderful panel. Thank you guys so much. You guys are always fun, a lot of dynamics. So John, I'd like to turn it back over to you for any final thoughts.
Yep, I told you all it would be very spirited discussion. I hope you found it so. So thank you, Josh, Kim, Michael, Jim, and Will. You each exemplify the exceptional thought leadership for which the counselors of real estate is known. As inveterate problem solvers, counselors of real estate are prepared and equipped to help their clients and employers capture opportunities and devise solutions to complex real estate problems. Our public service initiatives, the CRE Consulting Corps and the CRE Foundation, offer a potent combination of expertise and funding to devise frameworks for decision-making for civic and nonprofit organizations. I'd encourage you to explore these valuable resources and consider engaging a counselor of real estate when seasoned advice or a solution to a complex real estate problem is needed. Perhaps you might consider yourself becoming one of us and seek the CRE designation. Please join us on July 24th for our next webinar on global property markets and the disparate trends, cultures, and perspectives. You may register at cre.org. Until then, on behalf of the Councilors of Real Estate, thank you for attending this session of What's Next for Real Estate and the Life Experience, and we'll see you the next time. Have a great day.
Thank you all so much.